Patrick Vernon here with another video about venture capital strategy, how to think like a venture capitalist. Today we'll look at the second step in the VC job cycle, finding and investing in startups. In the book, I divide these activities into three main buckets: finding the startups, doing research to make sure the startup would be a good fit, and finally agreeing to terms. Finding great startups is called deal sourcing and requires a lot of energy and strategy from the VC firm. Recall from the fundraising video that VCs pitch a strategy to LPs. That strategy often includes some special way to get to startups. A firm's proprietary deal flow could be its secret sauce, its competitive advantage over other firms. And they achieve that deal flow through networking. It is perhaps a VC's most important core competency to maintain relationships with a multitude of constituencies. VCs tap into their networks for all aspects of their job cycle: fundraising, investing, growing, and exiting. While any of the groups here could be the source of the next great startup for a VC firm, perhaps the most important source is other VCs. To put that into context, let's look at a specific fund strategy. Let's say we have a $150 million early-stage fintech fund based in New York City. We are likely to see many startups that do not fit our fund profile before we finally find one that's a match for us. Good on us, we can move forward with that deal. Meanwhile, it occurs to us there's a bigger firm out of Boston with whom we've done deals before. They might be interested in this $75 million Series C that we couldn't touch. Firm strategies can differ across several axes: fund size, startup stage, sector focus, geography. When we see deals that don't fit our profile, we'll refer them out. The more we create value in our ecosystem, the more value will come back to us. Speaking of us, back to our deal, we're going to need some help to get to exit. We only have $10 million to invest across all rounds to exit. If our startup is going to raise a Series B or C, we'll need help from other investors. Syndication to the rescue. A syndicate is a group of VC firms each investing in the same round. On the one hand, it seems a little counterintuitive. If we have a hot deal, why would we share it? On the other hand, it has become ubiquitous in the industry. How ubiquitous, you might ask? In this somewhat random sampling of Dan Premack's daily pro rata email, there are 21 venture deals listed. How many can you find that don't indicate a syndicate? Press the space bar to pause if you'd like to go fish. I only count 2, and it speaks to the tremendous benefits of syndication. The first of which we've already discussed: startups in our portfolio are going to need more funding than we can provide alone. Other VC firms bring benefits beyond cash. The more people we have in our corner rooting for our startups, the higher our chances for success. And while this last one may seem a little silly or trivial, it's hard to overstate how difficult it is to differentiate between genius and crazy when you're in the business of discovering disruptive technologies. Of course, there's a downside to syndicating, and it's a big one. More firms in on the deal mean more slices to split up the pie. However, if we've built the right syndicate, we should expect a bigger pie to split. This won't be the last time we see the VC network as we go through the job cycle, but deal sourcing is certainly a main goal of the network. Once we've found a startup we're excited about, it's time for due diligence. More broadly, the phrase due diligence basically means do your homework. For VCs, it's a complicated decision-making process, and time is an issue. There are many activities that can go into the due diligence process. So much so that you can say that due diligence is happening all the time. That said, there are a set of pre-term sheet issues that I'll call strategic due diligence. Half of my book is dedicated to a due diligence framework I call VC Razor. There are also many great resources online if you search for VC due diligence. If we like what we're seeing in the due diligence process and we want to invest, it's time to put down a term sheet. A term sheet is a negotiated legal contract that spells out all of the terms of the investment. While my book will touch on some of the top strategic terms, I highly recommend Brad Feld and Jason Middleton's Venture Deals if you want to dig further. Or again, you can search for any of these terms to find excellent descriptions online for free. The two most important terms in any equity deal are going to be the pre-money valuation and the investment size. These are the terms that determine how the pie will be split, also known as pricing the deal. A quick refresher from our What is Venture Capital video. When VCs invest, they receive newly issued preferred shares of stock. To price those shares, the VCs and founders must agree on a pre-money valuation, which represents the value of the startup before receiving any cash from the VCs. After the investment, the result is a larger pool of stock and a higher post-money valuation. Note that the founders have gone from 100% ownership of the pre-money valuation to some smaller percentage of a higher post-money valuation. This is called dilution. You can calculate the founder's percent ownership by dividing the pre-money valuation by the post-money valuation. Similarly, the VC ownership is the investment divided by post-money. This gives us the three most basic formula for VC deals. Hit the spacebar if you'd like to grab a screenshot. For a quick example, if we have a $3 million pre-money and a $2 million investment, we'll have a $5 million post-money. After the investment, the founders will retain 60% ownership. Note that 60% of $5 million is the same value as 100% of $3 million. The VCs in this example will end up with 40% ownership. If we turn this around and state the investment first, we have what VCs would traditionally call a 2-on-3 deal. That's a $2 million investment on a $3 million pre-money valuation. A 5-on-10 deal would traditionally be a $5 million investment on a $10 million pre-money. I say traditionally because there's a trend in the industry to use the post here and call this a 5-on-15 post, which is exactly the same as a traditional 5-on-10 deal. You might even just hear 5-on-15 and not know whether it's pre or post, a trend that's created confusion and ill will. A 5-on-15 pre is a $15 million pre-money. A 5-on-15 million post is a $10 million pre-money. Where did that other $5 million go? To be honest, I find this quite irritating, and I blame, in part, the show Shark Tank. On Shark Tank, founders offer a percentage of their company for an investment. Something like 40% of the company for an investment of $400,000. There is no mention of valuation at the outset, and invariably, if it's ever brought up, it's by a shark saying something like, "Do you realize you're valuing your company at $1 million?" In our heads, we can figure out that $400,000 is 40% of $1 million, so that sounds about right. No. Hit spacebar if you want to figure out the lie by yourself. If you're going to tell me I'm valuing my company, then we're talking about my company right now, today, as I pitch to you, not later after I receive cash from you. So we're talking pre-money, not post-money. If we add the $400,000 investment, we get a post-money of $1.4 million. To determine the investor's ownership, we divide the investment by the post-money, in this case $400,000 by $1.4 million, resulting in approximately 29% ownership. But wait, we were offering 40% ownership. So this statement must be wrong. Perhaps the shark meant $1 million post-money valuation, which, let's acknowledge, doesn't really make sense. We don't have the $400,000 in our bank account yet. In any case, if it's $1 million post-money, what's the pre-money? To get the pre, we just subtract the investment from the post, and the answer is $600,000. Perhaps that's what the shark meant to say, but that strikes me as a pretty big mistake. Sadly, VCs have started using this methodology, and it begs the question, is it lazy or a lie? If we give the investors the benefit of the doubt, certainly the math is easier in your head if you just use post. If you say 2-on-3, you have to add that up to 5 to figure out that 2-on-3 means 40%. However, coincidentally, it benefits the investor in negotiations to falsely imply the higher price. Why does it matter so much? Because pricing the deal is a big deal. In the book, we discuss some methods that early-stage investors use to avoid pricing the deal. Changing the price, the pre-money valuation, has dramatic effects on the ownership structure. As the pre-money valuation goes up, the VC ownership goes down. Notice in these examples, we're talking about the same $2 million investment that would be used to fuel growth in the startup. But the investment size itself is also negotiable and has an effect on the ownership structure. A larger investment results in a higher percent ownership to the investors, and the extra cash could fuel faster growth. The investment size and the pre-money valuation work together to determine the amount of VC ownership. VC deal algebra isn't complicated math, but it can be tricky to do on the fly during negotiations. Hit spacebar if you'd like to grab a screen capture of this cheat sheet. We've scratched the surface into how VCs find and invest in startups. In the book, I cover these other topics, and it may be no surprise that this is the longest chapter of the book. You can find more excerpts and videos at vcrazor.com.